Hey everybody, it's Hammer, and this week I am joined with I will say, I don't get to say this every week, but with my friend Nathan Einkorn, who is a vetted VA VVA5 member, aren't you? VVA5?
Four.
Okay, VVA4. I was going to say, get cracking. And we are here, of course, with your mortgage market update for this week. And this is the week of August 31st, 2022. It is that Wednesday. Tell us a little bit about yourself, Nathan. Tell us a little bit about where you originate and what you do.
So I've been originating since 2004. I'm in Colorado primarily. That's my home state and where I like to roam. And have been in vetted VA almost since the beginning. I've run a couple squads and just been helping out in this community as much as I can, as long as Chris and Nate allow me to continue.
Awesome. Well, fantastic. Thanks for joining us this week. This week, we're going to talk at the beginning of the conversation. We're going to start talking about rates and kind of where they've been and where they're going. And then we're just going to jam and talk about what, housing market and mortgages and anything that you think is a good part of the conversation. So let's see, a couple of housekeeping items. If you're here live, do us a favor. Go ahead and say good morning. Let us know that you're here. Give us a hashtag live. Be a part of the conversation. It does make these a lot more fun. Ask us any questions. Share your thoughts. Give us an amen, anything that works for you guys. Also, if you're watching on the replay, remember, we do monitor these posts for you. We're here for you. Give us a hashtag replay. Let us know that this was helpful to you and that you want us to keep doing these for you every week. We do monitor it, so ask your questions or share your thoughts, and we'll be watching those as well. So with that said, let's do a quick recap of what happened last week and where I thought things were going this week. So I wrote this on August 29th. That was a couple of days ago on Monday on where this week was going to go. Recap of last week, mortgage rates did move a little bit higher again. We're probably at the highest rates we've seen since since June. Does that sound about right to you, Nathan, that we're since June, probably, with the rates we're seeing now?
Yeah, I think that's probably where they peaked, and we've just been kind of riding that up and down roller coaster since then of peaks and valleys. But yeah.
Yeah. And as mortgage professionals, we've seen this rodeo. We've seen rates go up and rates come down and rates go up and rates come down. So for us, we may seem a little lackadaisical about it or, nonchalant, like it's not a big deal. But I know if you're looking at closing on your house and you've seen your rates go from, 4 3/4 to 5 1/4, and you're like, hey, this isn't cool. So we get that. The reason that rates moved last week was a lot of the inflation data and comments by Fed Chair Jerome Powell at the Jackson Hole Symposium. So the Fed, they get together, and I don't know if they go, water sliding or what they do in Jackson Hole in the summer. There's no skiing, but they do get together, and it's not a normal Fed meeting. The normal Fed meeting will happen on September 21st. That's called a Federal Open Market Committee meeting, or an FOMC meeting. And the Jackson Hole Symposium, a lot of the different Fed members kind of voiced their opinion on where they thought the Fed funds rate was going to go and what the Fed was going to have to do to slow down the economy and fight inflation. So we saw rates move higher, and we've talked about this a little bit before. A lot of you will see the Fed funds rate move, and you'll see headlines that the Fed raised rates, and you're like, oh my goodness, mortgage rates just went up. And actually, mortgage rates go up on the speculation of what the Fed is going to do later on. So we're a month ahead. We're kind of buying the rumor and selling the reality is what happens. So right now we've seen mortgage rates kind of creep up a little bit. It's because of the inflation data that came in, which wasn't too bad, but it wasn't that good either. It didn't show inflation going down that much. And also because of the Fed saying that they were going to be as aggressive as they needed to be to push down inflation. And that spooks everybody. So we've seen rates kind of creep up a little bit. As far as what I think was going to happen this week, I had forecast that rates could improve. And I have a caveat, though. I have a big but on there. And I say rates could improve this week as talk of a slowing economy and a falling stock market fuels fears of a coming recession. However, and there's that caveat, we could still be a week away from improvement if bond prices start to slip this week as investors panic, pressuring rates higher instead. Now, there's a bunch of jargon in here that I want to kind of remind everybody. Those of you that watch weekly, you'll know kind of what I'm talking about here. But those of you that may be new, mortgage rates really have two main variables. The first one is what's going on in Wall Street with what's called mortgage-backed securities. And this is where the money for mortgages comes from and why we always have new money to lend. Otherwise, we would run out of money. So mortgages are sold on Wall Street as securities, and that's what replenishes it. So as these bonds go up or down in value, that affects mortgage rates. The other variable, of course, that affects mortgage rates and why we encourage you to shop around is the lender. The lender has a certain margin that they need to make as a company for profit. Some companies run more efficiently than others. I won't call any of them greedy, but I will say, a big company with a lot of, extra staff might take more expense to run. And sometimes you've got companies and brokers that can run at a leaner margin. So that's the second piece that comes into play. So when it comes, the one thing that we talk about is what's going on with the market, because that's the piece that's going to make rates go up for everybody, whether it's Nathan or Wells Fargo, they're both rates are going to go up based on what's going on in the market. Nathan, does that make sense to you? Does that sound about right?
Yeah, absolutely. I always tell, when borrowers are talking or, especially with embedded VA, when our clients come and talk to us, it's simple. It's a very, very simplistic way of looking at it. But I always tell everybody, hey, the bigger the company, the more people have to get paid on your loan.
Yeah.
It's just the way it works. So, it's an advantage that we have on our side, but it doesn't mean that everybody prices that way. And I will use the word, there are a lot of people out there that are plenty greedy.
There's definitely some. So, all right, everybody, we're going to show you some fancy chart talk. And this is a Japanese candlestick chart. And what I just drew on the screen is to get ready for college football season. It is the pennant. Actually, it is not just for college football. This is what we call technical analysis. So when I say this is why I think rates are going to get better or why we think rates are going to get worse, we're looking at two different variables. We look at the technicals, which are how these bonds are trading, and then we look at the headlines. So I'm going to move this out of the way for a minute. We look at what's going on with headlines like, hey, Powell abandons. Well, this one's not loading very quickly. Let's see if we can't refresh it and get that one to load. So, but how Powell is basically came out and said, we don't think we're going to get that soft landing anymore. We think the economy is going to take it on the chin. And they call that a growth recession. That is an oxymoron because a recession means that you're going backwards. But they now it's kind of like going from DEFCON 3 to DEFCON 4 instead of a weak or a soft landing, which makes me think of feather pillows. We now have a growth recession. And we look at these headlines, and that kind of gives us an idea of which way things are going to go. So going back to this chart, when we saw this pattern that these bonds are forming in all these candlesticks, we were looking for things to either break up or break down. Now, if they break up, that's good for mortgage rates. And we say, okay, we're likely to see rates improve over time if we see this. Instead, you can see down here, these are all moving in a downward direction. If I run this arrow through and I make an average out of these, we're moving obviously in a downward direction. So this, when the bonds move down, that's bad for mortgage rates, and you see your mortgage rates creep up. And in fact, as you go through along the date, you can see that at the end of July, rates were better, and that through August, rates have gotten worse, just week over week. And it hasn't been any huge movement, but it's just constant movement. We've seen here on the bond market, as bonds lose pricing, we've seen mortgage rates creep up a little bit higher. So when this stops and we see a reversal in direction and things start to move up, we will see mortgage rates improve. And that's what we're watching for. So we're watching on the market and we say, okay, do we think we've hit a bottom yet? And that's a yes. I think we are close to a bottom, but there is a caveat. You don't, the crystal ball is always a little, maybe some grease, maybe some burger grease on it. And it's a little unclear. When we look at that crystal ball, I would say that we are very close to hitting a bottom and that we should see a rebound. And we're watching these mortgage bonds. And then this other chart up here, we're watching what's called 10-year Treasury yields. So the 10-year Treasury, that you can see everywhere. Now, as a consumer or a loan professional, you may not be able to find mortgage-backed security data without paying for it. We have to pay to get this data. But 10-year Treasury data is out there on every news source. And if you see this yield go higher, that means your mortgage rates are going to creep higher. If we see this yield go lower, that means your mortgage rates are going to go lower. So we're watching this, and it's not a direct correlation. It doesn't mean if the 10-year goes up today, rates went up today, but it means general direction. Well, we're watching to see if this caps out exactly at this 3.11 level or 3.11. And if that yield holds around that level, that's a good sign. And I'm expecting that that'll hold. And I'm expecting we'll see that this 10-year yield will start to drop back below 3% into the twos, which will bring mortgage rates from the like right now. The VA mortgages are generally, I would say, they're in the kind of the 5 3/8, 5.375 area. We would see them drop back down towards the fours if we can see that 10-year Treasury yield drop. Now, what would cause this to drop? Why would we see this happen? Why do I think that rates are going to get better and that you don't have to panic if you're buying a home and you go under contract right now, or you've got new construction and you're a few months away? You don't need to panic that rates are going to be up in the sevens. It's not going to happen. We're going to see rates that are going to drift back down, and it's because of these headlines. And it's really, as I've talked on some of these other past calls, it's a two-horse race: fear of inflation versus fear of recession. Every time that we see fear of inflation increase, rates go up. If we see fear of recession increase, rates go down. So we've gone through the last few weeks and we haven't heard a lot of talk about recession. It hasn't been dominant in the headlines. Well, it's starting to make its voice known again. We're seeing more conversation about recession. And as investors and as the markets grow and fear this coming recession, and how bad this recession will be. And as somebody like, the Fed, when they even admit and they say, hey, this recession that's coming is going to be worse than we thought. The economy is going to slow down more than we thought. And as that happens, we're going to see mortgage rates improve. It's just a matter of when, not if, in my mind. So if you've got a loan that's closing in the next couple of weeks, you may not see a big move down in rates. And you may want to just be very aware of, a conversation with your mortgage professional. Talk to them, get their opinion, and do what's right for you. But if you're out there house hunting right now, don't panic. It's still a fantastic time to be looking at a house, and you guys will be doing amazing. So that's kind of my bit there. I'll give you guys a quick breakdown. In the next week or so, I think rates are going to improve just a little bit. Unless Friday, we're going to get some jobs data. If that jobs data comes in very strong, it signals a strong labor market. And there's two components to the economy that the Fed are watching. They're watching all the economic reports for how warm and how hot the economy is running, and they're watching the labor market. And if the labor market starts to weaken, then that's going to actually be good for mortgage rates, even though it's not good for everybody else. If those jobs rather, if it's a hot report, we see a lot of new jobs created, that could be something that gives us a day or two of, some heartache, as mortgage rates will kind of get a little bit worse before they improve again. So that's kind of my take there. But I think over the next few weeks, we will see rates come back down. I think you're going to see rates for your VA loans go back into the fours. But again, that's forecasting. So do with it what you will. All right, Nathan. So now what do you think of all that? And any questions or anything you would add?
No, well, going back to what the Fed does in Wyoming, I always picture that scene from DuckTales, right? Where Scrooge, I think that's where they moved all the gold from Fort Knox, right? They moved it into Wyoming, and the Fed goes out there and they just swim around.
Swim around in gold coins.
Yeah. That's what's going on. No, I follow you, and you're right in line with some of the other guys that I pay attention to for the economic forecasting, specifically as it pertains to mortgages. And when you're talking about, hey, rates are going to be going down, and especially if you're closing in the next 30 to 60 days, unless you have to, like, I see a lot of people talking about 2-1 buy downs or buying down the rate or getting seller concessions, and I'm sitting there going, and I may be way off, but I'm like, don't do that. Or use that money to use seller concessions to cover closing costs, but don't buy the rate down. Because...
Well, and talk about that. So let's take a minute. Let's break apart that jargon. So you mentioned two things there that people, if you're looking at a home and you're getting a mortgage, these are pieces of conversation that may come up or things you may read. The first one is buying down the interest rate. So can you explain to everybody what does that mean if they buy down the interest rate?
So you're going to have, in our industry, most people will call it the par rate, right? That's typically what you're going to get from most mortgage lenders that the more loan officers when you're talking to them. Advertisements that you're going to see are going to be different, but when you talk to your loan officer, they're going to, hey, the rate today is 5.375. That's the par rate, meaning it's the lowest rate that's offered without paying any additional points, or points are essentially a percentage of the loan amount to get a better rate. So if 5.375 is par, well, if you pay 1 point, which is 1% of the loan, so let's say it's a $500,000 loan, that means you're going to pay $5,000 and you're going to get 4.875, right? So you're going to get half a point, a little bit better than half a point better, or Yeah.
Right.
than where you're at. And a lot of people, they're encouraging that. Sometimes you have to do that in order to qualify, right? Especially right now, we're getting a lot of our clients, especially ones that have PCS'd in the last 2 or 3 years, right? Say you PCS 2 years ago and now you're moving again. Well, man, that's some sticker shock, right? Because when we did your purchase 2 years ago, you were at 2.25 or 2.5%. And now you're moving, right? And you don't have a choice. You've got to move. And that same $500,000 loan that you got is double, right? What you were at before. And so you're seeing a lot of these points that are coming up, or hey, use these seller concessions. But like I said, when you're in an increasing rate environment, which is what we've been in for the last 9-10 months, buy downs, okay, they make sense. If you're trying to manage that payment, they make sense. But if you're going to be in a home, and this is more for people that are going to be in their homes long term, I wouldn't say for anyone, especially if you're active duty and you know that you're going to be moving or PCSing anytime soon, talk to your mortgage advisor and do what's best for your specific situation. But if you're in a long-term hold, right? If you're a buy and hold and you're going to be in this house for several years, the reality is, based on the projections of a lot of the market analysis that we see, is in the next 18 to 24 months, you're going to see rates in the 4s. Well, the best thing about the VA loan is the IRRRL. I mean, not the best, but one of the best things about the VA loan is the IRRRL, the interest rate reduction refinance loan. It gives you the opportunity with no appraisal, with very low cost, to reduce your interest rate, do a streamlined refinance. And if you're at 5.375 now, and 18 months from now, it's 4.375. It probably will make sense. Once again, everybody's situation is different. There's no just vanilla blanket for everybody. This is if you'll wage stop a point, you have to refi. That's not what I'm saying, but that opportunity would be there. And in fact, with some of my clients, I'm actually recommending the opposite of like, hey, 5.3, if you're not getting a seller concession on your purchase, then instead of taking 5.375, let's take 5.625. And now I can give you, as a lender, I can give you a credit. I can give you, $6,000 to cover your closing costs. And then in 18 months,
finish that.
Well, in 18 months, if the rates drop where they're expected to go, and now we're down at 4.375, we can drop that rate down to that amount. Down to 4.375, doing the IRRRL, and it's all math. It's not like a matter of, a lot of people look at this, and I'm not encouraging churning in any way, shape, or form. It's just finance basics. If you're gonna, 3.75 and 4.875 is $260 a month, and it costs you $5,000. Well, it's just math, right? How many months do you have to be in that home to recoup your cost?
Right. So just I put it on the screen so everybody can kind of have a visual to it. So when Nathan, as a mortgage broker, when he says, okay, today for you in your scenario, remember, scenarios are always different. That's why we can't tell you, this is the rate today. It depends on your credit score, depends on the loan amount, depends on a lot of different variables. But if Nathan looks at your situation and says 5.375 is a par rate today, and par means it's not going to cost you any money to get that rate, but we're not giving you any money either. Then we can move up and down a scale. And this is all based on profitability of the mortgage to the investors that we talked about. And we don't want to go too deep down the rabbit hole, but we have the ability to go up and down a scale. And Nathan could say, hey, if you take a slightly higher interest rate, say 5.5%, now your payment, maybe you're paying, again, these are just made up numbers to be very clear, everybody, to make it easy to understand. But let's say your payment here was $900 a month, and now your payment here is $925 a month. But we can give you $1,000 toward your closing costs. So you have to come to closing with less money. Or maybe you want to take 5.625 and it's $950 a month. And basically you're getting upfront credit, which can help lower those costs, and you're taking a higher rate, which will cause you more interest over time. But we can also go the other way. And you could say, hey, I'm going to be in this house for quite a while, so I don't want that $900 payment. I want $875 or maybe $850. And it's going to cost you this money up front to get that rate. And that's why when you said the math, you're talking about, okay, well, if there's a difference of $25 in your payment, how many months is it going to take you to recover $1,000? and that's where the math gets figured out. And then not only do you have to look at the variable of how long are you going to be in the house, I'm going to come back to seller concession, but how long are you going to be in the house, before that you're going to have the mortgage? That's the first question. But the second one is, will I refinance? And this is where I come into the conversation and I say, in 2023, I think rates are going to go lower. And if you were taking a mortgage today and you had to take that interest rate of 5.375, I wouldn't pay points. And this is something you have to discuss with your own professional to do the math, and you have to decide for yourself, because I could be wrong. But when, we monitor these markets, we talk about this every week. We think rates are going to go back down into the fours, over the next few weeks. So if you close today and you close at 5.375, you have to wait 210 days. And it's, is it 6 or 7 payments for the Earl?
6.
So tell everybody.
6
that was
payments.
My softball. So tell them. So you need 6 payments and 210 days from your payment.
210 days before you can take advantage of the Earl. Correct.
Right. So if you look at this and you go, hey, I think rates are going to go down, maybe I'll take $2,000 up front with the idea that in 6 months, 7 months from now, I may refinance. That's something that you have to decide if that's a right fit for you. Maybe you take that par rate because you don't want to take a higher interest rate in case you don't refinance. But what I would strongly caution against right now is buying down the rate, because if you spent $2,000 today to get 5.125, or what we say 5 1/8, and then 7 months from now you can get 4.5, you're going to take it. And that means that $2,000 that you spent, you only saved $50 a month for 7 months. You saved $350 and it cost you $2,000. So that's where that math comes in of, hey, it's going to cost you this long in time to recover the cost in money. So, and then Nathan, can you tell everybody what a seller concession was?
Seller concession is something that's negotiated by your realtor. And that's where the sellers are going to take a portion of their proceeds. So if they're making $200,000 on the house, but they're going to take $5,000 of their profit, and they're going to give a seller concession to you, the buyer, to help cover your closing costs, cover your rate buy down. I mean, you can use it. It has to be real closing costs. You can't get more than what is actual. But and then just stepping back real quick too, when we're talking about buying down rates or taking lender credits, these are discussions like Cameron had mentioned. We're making very blanket statements. Every loan is as individual as your fingerprint. Your loan is not going to be the same. You can have another buddy who's in the same MOS, the same pay scale, everything about your paycheck, everything is the same. Your loans are not going to be the same. It's just not the way that it works. So this is a discussion that you need to have with your loan officer, and your loan officer really should be having this conversation with you, right? They should be presenting all these options, educating about it. And I even go a step further. I recommend you talk with a financial planner, because your risk, your overall risk for your own personal financial goals and your situation is yours alone. So bring in multiple, advisors if you have the time. That's why it's so important to get started as early as you possibly can. But these are pretty blanket statements. So when you're for your loan, it's
right.
going to be very specific to you on what you should or shouldn't do, but you definitely should be discussing all these options and weighing everything based on your future, based on your, whether if you're still active, you're going. I mean, you're more likely going to PCS. So it just do your due diligence, get started early, and get all these questions and all these scenarios knocked out as soon as you can, because that way when it's time to buy, everything's rock solid.
And if you have any questions about any of the things we're discussing, though, the Vetted VA Facebook group is a great place to go ahead and ask those questions. Yeah. You've got moderators like Nathan that don't have a dog in the race. They're not going, they've got no reason, personal reason to invest it in it to give you an answer. They're going to get you legitimate answers, neutral answers. They're usually going to refer back to the guidelines that you can confirm that what you're hearing is correct, because, of course, just because you heard it on the the internet doesn't mean it's true. Definitely it's great to crowdsource information from other veterans that are out there or active military that are out there buying right now and get their opinions on things. But when you see that moderator tab next to their name, remember that that's somebody like Nathan whose sole purpose here is to make this process clearer for you, educate you, help you along the journey, answer these questions for you without any kind of personal gain. So if you guys have questions about seller concessions, buy downs, if your lender is talking about these things and you want a second set of eyes to explain to you what it means or why it's there, then remember you can come to that group, and this is where you'll get those answers for those, right, Nathan?
Correct. And I did want to add one more thing. When it comes to seller concessions, that's very, very market specific. So there are markets in the country right now that are still super hot, and you're not getting any lender. You're not getting seller concessions. So that's something where you want to. It's definitely a question to ask, but consult with your realtor. They're the experts. They're the ones that know. Hey, and it's almost. I mean, it's neighborhood specific here in Colorado. There are certain places where oh man, we just had one where we got like $3,500 in seller concessions, and I've got another one where my client's paying over asking. So and it really is market specific.
And sometimes it's better than offering a lower price. Is you'll say, okay, I'll pay this price, but will you give this concession? Because if you're maybe, it helps to keep some more of your money in the bank. Maybe you're going to use that money. So my kids just put a offer in on Sunday, and it was accepted. And the house was listed at the moment for $303,000, and they offered $300,000. And, somebody said, why didn't you just do the 303 at that point? And the reason I didn't, I don't want to take up too much time. I'll show you guys. Actually, you know what? We got a minute, Nathan. You're still doing good on time?
Yep.
I'll show everybody a little trick when you're looking at things, and what I looked at as somebody being in the mortgage business for as long as I have, and all these different things. So let me pull this up on the screen, and I'll show you guys the Zillow article here. So what I was looking at, and again, and by the way, Phil, thank you for all of your participation. I see all your comments and appreciate it. Other comments, if you guys are a Facebook user, unfortunately, if I don't see your name, because we don't have the permission on there, but I appreciate all your comments and providing the feedback as well on all this. Please continue commenting. So this is the house that my kids, it's now pending sale, and they are the ones that are buying it. And what I did is I noticed that this house was owned by Open Door. Open Door is a corporate company that goes in and basically house flips, and they do it in a very particular way. They will buy a house, and in this case, they bought this house. If we look at the price and tax history, they bought this house in May for $296,100. And what they did is, if I go ahead and show you guys I'm going to show you the Google Street View of this house from May of 2021, and you'll see what they did. And basically you could see that this house might have had some unique properties there, like all the furniture in the carport and the no trespassing signs and, the tent in the yard and the cars that have grass growing around them shows that they haven't moved in a long time. And the shutters being taken off the house here, and the paint was all peeling off and bad. And you compare that to what happened is they bought the house, they dressed it up, they refinished the floors, they painted everything. They put some money into it, but not too much. And then they listed it a month later, or about 6 weeks later, for $327,000 is what they listed it for. And then they didn't get enough activity. So then about 15 days later, they dropped the price $4,000 so that they would get more activity. Then they were not getting enough activity. 15 days later, they dropped the price. This time they dropped it by $6,000. Then they came in with a very large drop. This shows you where the desperation started to come in. So this is a company-owned home. There's no person on the other side that's making that decision of when it's a good time to sell this house. So this is a company that's using a spreadsheet, basically. And what they did is they took their 317 price and they dropped it down to 306. They dropped it $11,000 at the end of July. The next move was much smaller. That shows that they're basically hit their point where they'll let the house sit because they need a minimum to recover on it before they're willing to sell it. They dropped it to 303 on 8/11. It's showing pending sale at 303, but we offered 300. So I don't know why they haven't fixed that, but I did tell the kids to go ahead and offer. Yeah, because it's Zillow. I told them to go ahead and offer 300,000. Why didn't we offer 303? Well, the house needs work, and that's $3,000 in their pocket that they can put into work like new windows. So, but based on this pattern, we decided what we were going to offer because I looked at this pattern, and if I had seen large price jumps that they were willing to go lower, I would have said offer 290 something. But what this last jump showed me, they went from an $11,000 move back down to a $3,000 move. And it shows me that they're running out of room. So we offered that 3,000 less. And if we were coming in on on August 12th, I would have said to offer them the 303 because they've just lowered the price yesterday. But we were 20 days later. And, and I said, hey, they're going to lower if we didn't buy it, they're going to lower this price another, at least I'm going to say 3,000. So I felt comfortable that we could go in at 300,000, and we did get their offer accepted at 300,000. And that's how we make that decision. Like, these are some of the things that we looked at when making an offer. So you feel comfortable because when you're making an offer on a house, you know what a house is worth? What somebody will pay for it. That's like almost anything, and
I was just going to add what you did right there. I mean, that's just honestly, when people are always asking like, hey, how do realtors help? That's a tiny little snippet, a very tiny little snippet of what your realtor is doing for you on the back end when they are putting together a list of homes for you to go look at, right? Or when they're advising you on what you should offer. So, working with the right realtor, it is so imperative. I mean, there's so many just intangibles of the hard work that they put in. So thank them, and they are worth every penny. Always use a realtor. Whenever I have a client that comes in and is like trying to avoid, somehow the buyer's trying to avoid realtors. One, I'm always like, one, you don't pay for it, so you absolutely have to use one. But two, they are going to save you so much money. Yeah.
And remember, if you're looking for a vetted realtor, you will find vetted real estate agents through the Vetted VA website, as well as vetted mortgage professionals like Nathan. So if you're looking for somebody in your area and you would like a place to start, vettedva.com is a great place to start for that. Getting information, of course. Go ahead.
Oh, sorry again. Or if you have an amazing realtor that and a realtor that is knowledgeable, that supports the veteran community. The one thing about being a lender, it's easy, right? I'm in Colorado. I can cover all of Colorado. It's, we work on the internet. I do all my business right here in this place. Very rarely do I have to go meet clients. Realtors, it's not that way. I do know realtors that travel all over the state, but for the most part, they tend to be very centric. Like if they're in Dallas, they're in Dallas. They're not going to be able to help you in San Antonio. So if you know realtors in a specific area, please send them to our professionals group because we could definitely use some more. And same with lenders. If you got a lender that's a badass and that broke one of the rules there. If you got a lender that's great, we're always looking for solid professionals that we can add to better serve the community.
So awesome, everybody. Well, again, if you were watching live, we appreciate you giving a comment. Let us know that you were here. If you're watching on the replay, give us a hashtag replay. If you have any questions that we can answer for you, of course, post them here or start a new thread in Vetted VA in the Facebook group, and you'll get some great answers. Nathan, thanks for joining us this week. I appreciate you, my friend. Anything you'd like to leave everybody with, or are you good?
No, just, thank you. Thank you, our community. Thank you all for your service. If you got questions, hopefully we've got the answers.
Awesome. And then Phil gave us a kudos. Thank you, Phil. We appreciate you, brother. And everybody else, have a fantastic day. We'll see you next week. Bye-bye, everybody.